The biggest mistake a buyer can make, and I see it happen constantly, is confusing price with value. A seller can ask for anything. They can put any number on their business, but that number is not the value of the business. That number is what they want you to receive. What the business is actually worth and what you should actually pay are two completely different things. And knowing the difference is what separates buyers who build wealth from buyers who regret their acquisition details. If you've ever looked at a business listing in Africa and thought to yourself, how do I know if this price is fair? This video is for you. By the time we are done, you will have a framework for valuing any African online business in any sector, in any country on this continent of Africa. Let's get into it. Before we get into the methods, I want to address something that most valuation guides completely miss. The method we are going to cover today in this video is revenue multiple, and it's a universal framework. It is used in London, New York, Singapore, and even in Sao Paulo. But applying them in Africa requires adjustments that most Western guides never tell you. And if you ignore those adjustments as a buyer, you will eventually overpay, or you will walk away from deals that are actually worth buying. So let me give you the 4 key realities of African business valuation before we go any further. Now, reality number 1, the informal revenue problem. Many African SMEs, and when I say many, I mean the majority of businesses operating in Africa has a combination of formal and informal revenue. Now, formal revenue is what goes through the bank accounts. It gets invoiced and it shows up on financial statements. Informal revenue is what comes in as cash, mobile money, or through transactions that weren't formally recorded. Now, this doesn't mean that the business owners is doing anything wrong. In many African markets, right, this is simply how businesses work. But as a buyer, it creates a problem. How do you verify what you can see on a bank statement? The answer is that you look beyond the bank statement. You ask for mobile money records, M-Peso in Kenya, OPay or Flutterwave in Nigeria, MTN mobile money in Ghana and in Cameroon. These are the ways you can evaluate a company. You look at suppliers' invoice and work backward. You look at POS transaction records, and if you can't verify it independently, you don't include it in your valuation. It's as simple as that. A business that claims $500,000 in revenue but can only verify $300,000, it should be valued by $300,000. You negotiate based on what you can prove and not what the seller tells you. Reality number 2, currency and macro risk. If you are acquiring a business that earns revenue in a soft currency, talking about the Nigerian Naira, the European Yuan, the Ghanaian cedis, you are taking on currency risks. That currency may depreciate against the dollar, the pound, or even the euro while you own the business. And if you are planning to repatriate profits, that depreciation directly reduces your returns. So when you apply a valuation multiple to earnings that are dominated in a soft currency, you need to adjust downward to account for that risk. As a general rule, businesses earning in hard currencies like dollars, euros, or assets that are priced in dollars equivalent command a premium multiple. Businesses earning in soft currencies require a discount. This doesn't mean that you should avoid businesses with soft currency. some of the businesses in soft currencies have a good acquisition opportunities in Africa. For example, like in Nairobi, Lagos, and Accra. It means you price the risks appropriately to the currency valuation. Right, number 3, regulatory and license risk. This one catches buyer off guard, literally more than anything else in this list, and it can turn a good deal into an expensive mistake. In many African countries, business licenses are issued to the individuals who applied for them, not to the companies itself. That means when you buy the company, the license does not automatically transfer to you. It stays with the previous owner. Think about what that means in practice. For example, you buy a pharmacy or a financial service business or a logistic company with government contracts, and on day one as the new owner, you discover that the operating license needs to be completely renewed and applied in your name, which could take 6 months, 12 months, or even longer. So before you place a valuation on any African business, you must confirm if the operating license is transferable, and you don't just ask the seller, you confirm it directly with the regulatory body that issued it. It is not if it's not transferable, it's either a deal breaker or it fundamentally reduces the valuation of the business until the license issues has been resolved. Right, number 4, limited market comparables. In developed markets, buyers can actually access database of comparable transactions, similar businesses in similar sectors that sold at similar multiples, to benchmark their valuation. But in Africa, that data largely doesn't exist. Most M&A transactions on the continent are private, undisclosed, and not logged in any central database. What this means for you as a buyer is that you cannot rely as heavily on comps as buyers in Western markets can. You need to do more first principle valuation. That literally means that working from the actual numbers in the business rather than from the market benchmark. Now let's get into the method. Revenues without profitability tells you something, but it doesn't tell you everything. Before you apply a revenue multiple to any business, you need to understand 3 things. First, what is the path to profit? If the business is generating $2 million in revenue but losing $500,000 a year, you need to understand when and how it becomes profitable. What does that roadmap look like? Is it credible or not? Secondly, what is the burn rate? How long does the business have before it runs out of cash at its current rate or it loses money? If the answer is 6 months, you are not buying a business, you are buying a rescue situation. That changes everything in the valuation gap. Number 3, are the units economic positive? On a per customer basis, does the business make money? If it costs $200 to acquire a customer and each customer generates $50 in gross profit per year, you need 4 years just to break even on acquisition cost. That's a business with a structural problem, not just a timing problem. You've done the work, you have a valuation. Now you need to turn that valuation into a negotiation position and do it in a way that's professional, data-backed, and actually moves the deal forward. Let me give you 3 principles for valuation-based negotiation. Principle number 1, your valuation is your anchor. Show your workings. The moment you actually present an offer, you are setting an anchor for the negotiation. The number you name first has an outside influence and where the final deal actually lands. But the anchor only holds if it's credible. Walking into a negotiation and saying, I think this business is worth $400,000, with nothing to support it gives the seller no reason to move from their $700,000 asking price. But working in a room with a due diligence of the business that shows the multiples you have applied based on your own findings, the adjustment you made for currency risk and the owner's dependencies, all of these signal that there's a different conversation entirely. Now you're having an opinion-based negotiation. Principle number 2, understanding what the seller actually wants. In every acquisition, the negotiation headline price is not the only thing on the table. An experienced buyer understands that sellers often want things beyond just the headline numbers. They might actually want certainty that the business they built will be looked after. They might want to know that the staff will be trained and retained. They might want a clean exit. They might want to remain involved for a transitional period because they genuinely care about the outcome. When you understand what the seller values most, you can structure a deal that gives them what they need while protecting what you actually need. And sometimes that unlocks the price reduction that you couldn't get through pure negotiation alone. Let's bring this all together. The business are there in Africa. The sellers are ready. What has been missing is educated professional buyers who understand what they are buying and what it's worth. That's what we are building on this channel. That's what Africa Acquisition is designed to support. Your next step is straightforward. Go to africaacquisition.com, browse the live listing. When you find something that interests you, come back to this video and run it through the framework laid out. In the next video, we are going to walk through the complete step-by-step process of buying your first African business. From the moment you create your buyer's profile to the day you sign the papers and agreements and take ownership of the business. So if you haven't subscribed yet to this channel, do it so and don't miss the next video. Thank you for watching, and I will see you in the next video.